All right, we are recording. Well, thank you everybody for joining us. It is RRSP season, and Matt and I have decided to do I don't know what you want to call it, Matt, a high-level synopsis on what RRSPs are. So they're Registered Retirement Savings Plan. Thank you so much for joining us. It's a little bit chilly out there right now. We've been we squeezed our time in to get this done. So this will be on our YouTube channel. And for anybody who wants to learn about RRSPs, here we go. So my name is Lyle McDougall. I'm a certified financial planner, and I'm the managing director of Baker View Financial Solutions. And with me is my good buddy, Matt, who has a fresh haircut, right? Going rid of the military, buddy. Good for you.
There you go. Somebody's got to be patriotic around here.
We need more patriots.
We sure do.
We sure do. So the information, most of the information we have here is from the actual government website and from other financial planning sites. So we took it right from the horse's mouth. If there's any issues or concerns, please do let us know. So who I am, I already introduced myself. We're going to do a lot more of these. I think Matt and I have decided that these have been really good for our clients and really good for people that want to learn. So we're going to keep doing these. We're going to do them on topics, and we're going to see how things go moving forward. And hopefully just educate people as far as financial literacy. And that's it. Matt, why don't you introduce yourself?
I'm Matthew Fern from VMA Accounting and Consulting. Been in public practice my whole life since I was 16. This is, I think, year number 26. And we're just here to help people, especially with some common misinformation. I think the other thing, Lyle, and there's a lot of strategies involved in RRSPs that I don't think a lot of people understand. And there's more than one vehicle, as Lyle knows. TFSAs are great. There's times where you'll do TFSAs. There's times you're going to do RSPs. There's times you're going to do other stuff. So, it's there. Investing is not a one shoe fits all kind of model. Unfortunately, everybody thinks that's the case. Well, I always tell people one last thing.
Yeah.
If the banks advertise the heck out of RRSPs, that tells you they make a lot of money from RRSPs.
Yes, they do.
Putting it out there.
Yes, they do. And I mean, we're all entitled to make money.
Absolutely.
Right. But at the same time, it's like, okay, well, obviously, if they're doing RRSPs and they're just throwing your money into a term deposit, they're not doing any planning around it.
No, that happens a lot, Lyle. Seriously.
Yeah.
Like I see people just chuck money in and it's RRSP, I got to get it done. And then there's no planning. No planning happens for a year. And then, the next year rolls around and it's the same thing.
Yeah. Yeah. And I think that there's like, I agree. RRSPs can be a useful tool in certain circumstances.
Oh, absolutely.
I don't think it should be your be all and end all retirement savings vehicle. No. And there's a lot of reasons for that. And we'll go over those.
I'll put it to everybody this way. You're going to see an example today of where somebody paid $8 million in tax because they had so much money in their RRSP.
8 schmil, eh?
8 schmil was the highest tax return on death we've ever seen.
Yeah, so we got to pay for the pandemic somehow. So thank you very much.
That's a good start.
Jesus. Okay, RRSP facts and info. So here's some answers to some common. What is an RRSP? Well, an RRSP is simply a registered retirement savings plan. It can be any type of investment. Basically, you can even have real estate in your RRSP if you have the right vehicle for it. There are real estate funds and real estate investment trusts and all those types of things if that was an issue for you. But you can have seg funds, you can have mutual funds, you can have savings accounts, you can have GICs, GIOs. What else can you have, Matt?
GameStop.
We're not going into that right now.
I'm just kidding, but yeah, you can share.
You can have individual stocks. You can have your own individual stock portfolio. You can do your own management as long as it's
if you want to do it precious metals. I think there's even a precious metal trust in there too, isn't there?
Oh, there, dude. With exchange traded funds, you can invest in anything you want. There's ethical investment funds. There's precious metals. There's oil. There's cryptocurrency ETFs. There's all kinds of things out there. However, caveat on that is if you're going to invest in those, you better know what the heck you're doing. Don't do it.
Yes,
you're doing.
It is not a fad. Cryptocurrency is not a fad. It is as volatile a vehicle as you will ever see.
Yeah, I'm not a fan.
I It scares me, to be honest with you, Lau. The swings of like, 200% in a day, like just
Well,
doesn't make sense to me.
and it's not linked to anything.
Yeah, I mean, I
There's
don't
nothing
think
to
we're
back it
looking at
up.
it because of regulation, but I think there's more to look at things. But we agree on that.
Yeah.
It does. It scares me.
Yeah, no. So if you're doing a deposit into your RRSP for the year, it is it is reduces your taxable income dollar for dollar. And then investments are sheltered against every year against taxation. So you don't get any T slips on the growth of your investments. You don't get any growth slips. It stays in there tax deferred. So it's great as a accumulation tool to accumulate wealth. However, it's taxable on withdrawal and it's 100% taxable. So every dollar you take out of that RSP or RIF, however you look at it, is 100% taxable, and can be on a tax efficient basis if you do it right. And we're going to show you some situations where it's not tax efficient. And actually, most RRSPs, if the government is promoting it, are not tax efficient because they're actually making more money on it. And we can
There's a
cover.
couple ways they do that. I mean, if you've got a ton of RSPs, they don't have to pay old age security, right?
Yep.
You've got enough. People don't understand how the government likes this. The other thing it does is they know that they eventually win. The government is betting that you'll have money in your RRSP and that they'll tax you at 52%.
Yep.
Because I'll tell everybody out there that that's the top tax rate is 52% over 207,463 or something like that.
Yeah.
And a lot of the CPAs lobbied the government to say, hey, that top tax rate you said was for rich people. Why don't you give an exemption for estates? And the government came back and said, oh, hell no.
No.
That wasn't, we don't have an estate tax, but we do have an estate tax because we pay 52% on all that money.
Well, they're the champions of the middle class for a reason there, Matt. So
what, to eliminate it?
Well, I'm being cheeky, but the government came in as being champions of the middle class, and actually what they've done is they've impoverished the middle class substantially. And then COVID came along and just said, hold my beer and just watch what we can do. And anyways, we can talk about that forever. So you can contribute up to 18% of your pre-tax earnings for 2020 up to, or $27,000, $27,230, whichever is less. That is your deduction limit for 2020. If you don't use it, it carries forward. And that's why we see some clients that have hundreds of thousands of dollars in their RRSP contribution room. That room can be used for certain circumstances if you need it. And we have a nice example here. If you earn $60,000 in 2020, your RRSP deduction limit's 18% of that. So that's $10,800. And this is less than the maximum deduction limit. But be careful, because if you do over contribute, what's the penalty, Matt?
I think it's like 1% a month. So basically 12% you're paying. And it's a pain in the butt too. You have to fill out special forms to get it withdrawn. It's not like you can put it in and you withdraw it. I had a client do that. They over contributed and then just took a T4 RIF slip. I'm like, that doesn't eliminate the over contribution.
No, they still tax you on it.
There's another form you have to fill out. The other thing I tell everybody out there, if you're going to look at RSPs, go and get your RRSP room. Go get your NOA, get it from your accountant, get it from online. Don't trust anybody. Go get that information yourself, because what I've been told by every bank that this has happened with is that is your responsibility, not ours.
Yep. It is in fact your responsibility to know how much you have in your RSP room. It's not the banker. Yep. It's not the planner. It's not your accountant. It's your responsibility. So yeah, the penalty is 1% per month. So if you do a contribution of $10,000 and it's over contributed by that amount, your penalty until you fix it and fill out all the forms and deal with Canada Revenue Agency. Again, nothing, if you reverse it, you'll pay the interest and you'll be done. However, the reality is that dealing with Canada Revenue Agency is not a straightforward event. It is not easy. And once you start dealing with them, you'll know real quick that you want to keep your books in order and everything kind of clean. And again, not to try and evade taxes, but just to try and evade the cost of having to deal with them, because they are ruthless. And if they start looking at your stuff, you're not going to be happy about it. And so if you do over contribute, they'll send you a nice little letter saying you've over contributed and here's your bill. And on the $10,000 example, what's that? $100 penalty every month. So $1,200 for the year that you'd have to pay.
Yeah.
That gets rid of your deduction pretty quick. So we kind of already said this. How does the deduction work? Every dollar of contribution reduces the taxpayer's income by the same amount. For example, we have Jane. She's earning $80,000 in 2020, and her deduction limit for 2020 is going to be $14,400. We didn't talk about any carry forward room or anything like that. However, more than likely in Jane's case, she's got several $1,000s in contribution room available to her. And Jane contributes $10,000 to her RRSP. And so her net taxable income is $70,000. That makes sense?
Yep.
So the growth inside your RRSP is tax deferred until you withdraw it. Kind of already covered that. You can withdraw your RRSPs at any age.
Correct.
Sometimes people need to do it if they lose their job. Sometimes people need to do it because of certain financial hardship situations. It's usually the last place you're going to want to withdraw money from. So here's the problem that I have with it as a planner, Matt, and you can add your 2 cents in, is that it's usually the first go-to product for planning for retirement, but it's the last place you're going to want to take money out of. So it's not a flexible tool for you to use for your planning purposes because it's basically stuck. And I'm all about the cost of opportunity. Opportunity cost is a big thing. And if you're socking all your money into your RSP, you've lost a ton of opportunity to do other things as far as your planning is concerned, increasing your wealth, tax planning, that type of thing. Right, Matt?
Yeah, there's been a couple of situations a while. Like if I know, let's just say, I'll give you an example actually. One of my clients sold his business, huge capital gains. And he was going to take a couple of years off and go sail around the world. Literally, that's what he was going to do. So we did a huge RSP contribution. It brought he was in the 52% tax, brought it down. And over the next couple of years, we dripped it out. And you know what he did? He didn't need the money. He just used the money to lower his taxes, brought it back out at the lowest tax rate, and then put it into a TFSA.
Yeah.
So that's a little more complicated. There's a lot of fun things you can do with an RRSP. If you know, like you're getting a good example is if you're getting like a big buyout, say your company, I mean, this is going, I'm telling you right now, a lot of people are going to be hit by this. Let's just say you come and they say, hey, do you want to take early retirement? We'll give you a big bonus. We got to pay out all this money for you.
Yeah.
That's a good time to pull it into your RSP. And then let's just say you're 55. And unfortunately, I think if you lose your job these days at 55, I don't think you're getting rehired, to be honest with you. I think you're going to be self-employed. Then you might want to move your RRSPs over. If you're self-employed, me and Lyle will help you through this. There's a lot of fun things that we can do with RRSPs. Say you have to qualify for a mortgage and not in the next few years. RRSP management is really important. Now, we're not saying just pull the money out and blow it. That's not what we're talking about. What we're talking about is using all investment-based vehicles.
Yeah. And like I said, when you're just doing RSPs, you now lose control of your planning abilities to a great, and then it just takes more creative accounting on our part to try and make it work for you. So, anyways, we've got our example here. Jane contributes $10,000 towards her RSP every year from age 30 to age 65. She's done no early withdrawals. So I believe I put in a 6% rate of return in there as far as her overall rate of return for 35 years. She's going to have $1.2 million in her RSP. Sounds great, right?
Yep.
Sounds awesome.
Yep.
Until she starts withdrawing them and she's forced to. And we don't know if she's got a pension. We don't know if she's got anything else. But Matt, you did say that, you know, if you're making over, say, what is it, start at 75,000, I believe it is, or around that number.
It's like 60, it keeps on going up, but yeah, but then they start clawing back your OAS.
Your old age security is starting to get clawed back if you're making too much. And so that is not a contributory plan. That is a nice benefit from the government. It's for people that are over the ages of 65. It's free money. And you would be costing yourself, if you just did this, you would be losing that old age pension, because if you looked at the minimums, at some point in time, you're going to lose your RRSP or your RRSP withdrawal.
Yep.
Home buyers plan. This is a big one for the younger crowd. I myself did it. I regret that I did it, but I didn't know any better. I did it back in the 90s.
So did I. It's all good.
I put a bunch of, and we didn't have tax-free savings accounts back
No,
in the
no, we
day.
didn't have any of
We didn't
that.
have anything, and our RSP had to be, what was it, 70% in Canadian content back in the day as well,
Yep.
if you remember correctly. So it was even more restrictive back in the day. So home buyers plan allows you to take a $35,000 withdrawal out of your RRSP for the purchase of a property in Canada. And you must be a Canadian resident, and you have to repay it back over the next 15 years. So
Yep.
35K over the next 15 years, Matt, that's roughly what, $1,500 a year?
Yeah, $1,500. And then if you don't, it becomes income. Ours was a little bit different because, as you know, my dad was my employer at the time. So to qualify for my mortgage, I made $110,000 that year, put it into an RSP, pulled it out the next year, and gave it back to buy the house.
Yeah. And again, we do see a lot of it. I've done it for clients as well, and it's a great way to get into the real estate market. The problem is though that, and I'll kind of go over it, later on. We'll go over the problems with that later on. Lifelong learning plan. I don't think many people know this exists.
Nope.
I don't know anybody that's actually ever done this.
I have one client in thousands upon thousands of clients that ever took advantage of this.
I had one guy in university that was doing this when I was in college back in the day. And he was like an older student. Like he was, I don't know, he was in his 50s. So the lifelong learning plan allows you to withdraw up to $10,000 in a calendar year from your RSP to finance your full-time training or education. And for you or your spouse or common law partner, you cannot participate in the lifelong learning plan to finance your children's training or education. That is what a registered education savings plan is for. And we'll probably talk about those later on at a different webinar session. And you have to pay it back over the next 10 years. So again, you must pay it back, or they just add it to your income. In this case here, it's $1,000 a year that you'd have to pay back to your RSP after you're done your training. Opportunity cost, if you need to get a new job, or if you need, like, this might be a big thing for people back now with having to retrain and get new jobs with the new economy that's going to be coming out with COVID.
It's definitely something people are going to want to look at.
Yeah. So you were allowed to take out $10,000 out of your RSP tax-free to go to school. You just have to fill out a form and pay it back. It's similar to the home buyers plan. And that's for any training session as well. Like, you could learn to be a chef, you could learn to be a bricklayer, you can learn to be whatever the heck you want to be.
Yep.
I've never seen anybody actually use it in my career. I've seen one person use it back in the day, but spousal RSP, these are a good planning tool for a lot of people. A spousal RSP allows you to contribute money to your spouse's or common law partner's RRSP, and then you get the tax deduction. That's pretty much it. So let's just say you're in a single income family and you're making, let's just say you're a physician and you have a stay-at-home spouse that is raising the children. Again, doesn't matter if it's husband, wife, or whatever. Let's just say for this case, the husband's staying home. The wife can contribute to this husband's RRSP, spousal RRSP, and she will get the tax deduction, and that will lower the bill. So in situations like that, where income splitting is being eroded by the government, this is still there. And we can, if you're doing active RRSP management, which at that level is what you're going to need to do. This is a great tool. Again, takes more time, takes more effort, takes more planning. But this is a really good tool for people to income split on retirement, and also in single income households. There's not a lot of those anymore, or there's one income that's quite a bit higher than the other one. This is where this makes perfect sense. And, or if one is an employee, say a federal government employee or provincial government employee, and the other one is a business owner, that employee can contribute to the business owner's RRSP, because business owners tend to not have a lot of actual income. And if you're paying yourself in a dividend, you don't get contribution room for your RRSP. That is a big thing, is they want you to pay yourself a salary if you were self-employed, so that you can have RRSP room. And a lot of accountants will do that. Right, Matt?
Yep.
Like, you don't, and that, I don't think that that's the answer for everybody, but it is what a common practice is out there. So careful on your withdrawals. Home buyers plan is taken predominantly by younger Canadians. So here's the issue I ran into. I was in my early 20s. I was making okay money, but when you're starting out in your career, you tend to not make as much money, right, Matt?
Yeah, the lower tax rates.
Yeah, so you're making less money as you going along in your career, but you're putting money into RSPs and you're getting a tax deduction. And let's just say I was making $40,000 a year back in the 90s. That was, not bad money back then.
26% tax rate on your marginal tax rate.
Right. So in my 20s, and I bought a house, I qualified for my own mortgage, and I bought my own townhouse. And then a year later, I had to start paying it back into my thing. Well, I was making more money because I got raises and I got cost of living increases and then all these other types of things. But I had to pay that back. So I paid back $1,000 a year that was going into my RSP that I didn't get a tax deduction for. So if I wanted to get a tax deduction, I had to take it out of my cash flow as like increase my cash flow into my savings rather than, what I was already doing. So it does change your dynamics. And here's the other problem is the $1,000 that I'm not getting a credit for, but it's probably making, let's just say $50,000 now. There's a, 2 or 3% spread on that. They're collecting that 2 or 3% spread on the tax rebate.
Mm-hmm.
And they know it. And then you earn more in your 30s and 40s. Like that's a biological fact of when you start out, you get older. As you get older, you start to make more money until your prime earning years are in your 40s and your 50s. That is when RSPs you really need the tax deduction portion. But if you've done the home buyers plan, you don't have that ability.
Yep.
Like, I don't know, Matt, what are your thoughts on that?
Yeah. So what I recommend, especially if people want to start putting money away, is especially now, TFSA is your best bet.
Yeah.
So if you want to get high level, here's what we do. We look at your future profitability earnings, right? So if you're, I'm not trying to put anybody down. If you're in beauty school and you're going to be a hairdresser, most of your income is probably going to be tips, and you're not going to be making more than probably $40,000 T4 income, right? I'm just being honest. I'm not trying to put anybody's profession down, unless you own the joint. If you're training to be a doctor, especially a specialist, your future earnings are $750,000 a year. That's what it is. So when I have to give advice, I'm telling people, especially ones who are in lawyer school or professionals, or say even journeyman plumbers, they make a lot of money.
Yep.
Don't waste your time on the lowest tax rate. So the only way, yes, there's a tax deferral and we save money. I'm not going to time value of money. Me and Lana know that that's true.
Yeah.
The true savings comes when you're paying tax at a lower tax rate, but you've got the tax deduction at a higher tax rate. That's where the true savings happens. And you can actually, this is where we use this all the time, because you can save 20% tax using RRSPs depending on how much money you have. Like some people have, we call it peaks and valleys, right?
Yep.
Some people, like realtors, are a great example if they're proprietorships of peaks and valleys. So I know realtors that use RRSPs, but again, you're chewing up room, so I would do it differently in a corp. But the whole idea is, let's just say you had a good year, Lyle, and let's just say you've become an executive and you're 35 years old and you're making $158,000 a year. So your marginal tax rate, you're paying $8,000, a marginal tax rate of 42%, right?
Yeah.
If I was this guy, I'd say at the very least, put $8,000 into an RRSP and save that 42% on that money, right? And if he's really smart, or she's smart, put it into a spousal if they're making way less money, right? Because if they pull it out 5 years from now, tax rate's different.
Yeah.
And then let's just say, unfortunately, he loses his job, or let's just say, they retire. Your tax rate's probably going to be at the 20% level. You're saving over 22%. That's the true tax saving.
Yeah. And that's kind of what I'm going to recommend, is that if you have an outlier year, or if you're really starting to make some serious cash, and it's salaried income and you have no other ways to have tax deductions. And again, there are other ways to get a tax deduction. It takes a lot of planning and a lot more risk to get that tax deduction. But at the same time, there are ways to get it without doing RRSPs that are a little more flexible as far as your withdrawals and everything else. However, In this situation here, you got a dribs and you put it in dribs and drabs. You get an RSP loan and you get it. If you're bumped up through a tax bracket and it's 42 cents on the dollar that you get back, why wouldn't you do that? So again, RSPs are all great, but then you have to RIF them at some point in time. Now, here's the big thing that I know most clients that are approaching the age of 71, they start freaking out because they've never had to touch this.
Yeah, they do. Yeah, that's a good way to put it, Lyle.
They go because they've been accumulating their entire life, and honestly, when they're 65, most of them actually just shelve it for later because they don't actually technically need it, because usually they've done well in real estate, they've got some pensions, they've got CPP, they've got their old age security, they're probably doing okay.
All the stuff we're not going to have.
Yeah, exactly. All the stuff I'm not going to get.
That's right.
So when you hit 71, the age, you have to have it RIF by December 31st of the year you turn 71. So if you turn 71 in January, you don't have to do anything until December 31st. There's a misnomer out there that you have to do it on your birthday of 71. No, you have the entire year to wait. And the longer the better in my view. Unless you're going to take it out early, I think the longer you can reserve this, the better, and then try and take it out in dribs and drabs.
Well, at 65, this is what my personal feeling. This is when you sit down with your financial planner and look at all your money that's coming in.
Yeah.
And you start looking at, okay, well, and a good example is, I know you do this, Lyle. They get their clients to pull money right up to the point where they're going to get OAS clawed. That's what, like, I know you do that. So when you look at people, you're like, I know you don't need the money, but let's just get it out, put it over here in a TFSA. Yeah. But let's get it out so that you're not getting clawed, because and I know that if they wait too long at 71, they start getting nailed.
Oh yeah, they sure
especially later on in life when they really might need it.
Well, you look at the example of Jane, right, that we had before. Like at 65, she's got $1.2 million in her RSP, and we can take a look at that. I think is the next. Okay, so here are the RIF minimum withdrawal rates. So the RIF minimum is the minimum amount you can take out of your RIF. It's simply that. The government, so once you RIF your money, RRIF, it's an income fund now. It's not a savings plan.
That is correct. Yeah, and it's a forced takeout.
It's a forced takeout. So at the age of 65, if you see here, you're at 4%. So Jane, who has $1.2 million in her RSP, is forced to take out 4% of that, which is roughly what, 60,000? I'd say, yeah, 60 grand. So you think about that.
48K.
48K, sorry, 48K. It's early in the morning. 48K, but that's $50,000 of income. Let's just say she now has a pension.
Yep.
And the pension's paying her 40K a year.
Yep.
And now she's making 88K. And let's just say she has a rental suite.
And now you're fully getting clawed
now you're at $100,000 of income at the age of 65, and you're losing your old age pension. That is free money. So again, you look at it saying, okay, well, what's the plan? Well, it takes active planning for your entire life. If you're just relying on RRSPs for your retirement savings, good, go for it. But it's not going to end well for you. It's going to end well for the government. There's a reason why the government creates these vehicles, and it's not for our benefit. It's for their own. They know that, and we can talk about it on death as to what happens with this. And that's the real kind of.
Yeah, I mean, I'll tell the story now, actually, Lyle. So one of our clients, husband passed away at 59. She, of course, got all the RRSPs, lots and lots of money in the RRSPs, tons of money. Husband had done very well in the stock market, maxed out RRSPs. Now, on the date of death, all your assets are liquidated, right?
Yep.
There was over, I think it was 12, and this sounds like a lot, but trust me, it was there, $12 million in RIF.
Wow.
Between her and her husband, $12 million. And it got taxable. And unfortunately, she passed away, I think it was at the age of 70 or 71. And yeah, that all became taxable in 1 year at 52%, because she had other holdings, right? She had other real estate and everything else. And I remember her son coming in and just turning to me and said, no wonder the government likes us doing this.
Yeah.
The tax bill was over $7 million.
Yeah.
He was so like his parents had scrimped and saved and not taken vacations and done all this stuff and had done very well in their RSPs, very, very well. They both were highly educated. I think one was a teacher. I think the dad was a plumber. And they had done, he actually had done very well. His broker had done very, very, very well for him, actually. They had tons of money in these RSPs, but they didn't get to enjoy any of it. And unfortunately, neither did the kids.
And that's the problem, is that and the government, when they send you the tax bill, they want it now.
Yeah, I remember getting many phone calls from CRA on that $7 million.
You think?
Yeah. Oh, that's one thing. I remember the adjuster lady phoning me up because they had some questions on the value of the property that we'd used. And my response back to her is, $7 million not good enough for you?
No, not enough.
Because we'd used the notice of assessments. Of course, they didn't like that. And in the end, they just were like, yeah, you know what, we're not going to do anything about it. But I just thought it was funny that she had actually phoned to say, I'm like, it's $7 million, leave them alone.
Well, and let's just, okay, Matt, let's just say you didn't pay, or you paid late on the $7 million. Oh, they charge interest on that at 1% per month.
Yeah.
So it was 1% of $7 million.
That's almost loan sharking in today's environment.
Dude, it's crazy. When you can get a loan for what, 1.25% from the bank, and the government's charging you 12.
Yep.
There's something wrong with the system.
Well, our government's turned into money mart.
Well, yeah, and that's kind of what's going on. Anyways, and these numbers are lower due to COVID. So these are artificially low. Crank them up by 2% each, and that's usually where the numbers are going to be. And by age 90, you should be at 20% on your withdrawals. So they've done it where your market, and what happened was, this was an answer to when the markets tanked in March. When you're forced to take out money out of your RRSP and the markets have tanked, that's going to impact your financial plan forever, especially when you're retired. So if you're forced to take out money and the markets are down by a substantial amount, they've allowed people to lower their RRSP minimums for these couple of years. Now the markets are back up and they still have them in there. So I don't know how long this is going to be on for, but usually it's at 71, it's 7.28%. I
have a feeling while they're very happy to do this. Two reasons why. One, they don't want it out of the market. When the markets were really going low, if you were listening to BlackRock, they were saying, we do not want people pulling money out of the market.
Yeah.
And two, they also know that if they lower the rates, well, they get more at death. I mean, they're not stupid. The government is not stupid.
No. Yeah, they do get more at death. That's absolutely right. So if you lower the RRSP minimums by 2%, well, that's 2% higher on the withdrawal. Plus, if with the market values that are coming back, you're getting gains. So it could be even more than what they're going to do. So let's just take our case study of Jane. Retired at 65 with $1.2 million.
Yep.
Traditionally over 5% withdrawal mandate minimum, forced withdrawal of $60,000 of taxable income.
Yep.
Save it to 71. Traditionally, it's between 7 and 8% at age 71. So if you save it till 71 and you have it in there still, now you have $1.8 million for Jane in her thing at age 71. So that at 7% withdrawal rate is $126,000 of taxable income without any other sources of income. Your old age pension is gone. Your CPP is going to be taxed at, you're going to owe money at CPP because they're only going to do the withholding tax. I believe that's 20 to 25%, but your marginal tax rate on your CPP will be
much higher,
much higher than that. You'll get a pension credit, but there's not much that's going to be there. So your tax bill on 126,000 age 71 is going to be roughly, I don't know, what would you say, Matt? 30,000, 40,000?
It's going to be high. I'm just looking it up right now. So combined rate, you're paying a ton of money on that money, dude. It's like 34% on like 15, 18,000 of that.
Well, and here's a situation where Jane made $80,000 her entire life. Right. And again, this is hypothetical, but I've seen retirees making more money than they ever did when they were working.
Yeah, if they've done a good job and they've been pretty steady with their RRSP. I mean, the thing with RRSP is when you have a secondary pension, it really becomes prohibitive when you get older.
Yeah. Yeah. And I mean, if you're looking like, so on her $10,000 contribution every year at her marginal tax rate of 26%, she's getting a $2,600 tax rebate every single year. There is the strategy to take your tax rebate, pay down your debt, or put more into your RSP. That's also a strategy. However, now you've just supercharged your RSP, and I don't know if that's the greatest thing. And then also, like, here's the thing: be careful on death, because it's 100% taxable as income.
Yeah.
So let's just say she passes away and she's not married and she's got $700,000 left in her RRSP RIF.
Yeah.
That $700,000 is, and she's probably been living for 15, 20 years on that. She's in her, probably, if she started at 71, she could probably be 85 and still have $700,000 in there based on rates of return. Now you got 700K going out. The tax bill on that is going to be 400 grand.
If there's 700,000 in there,
Yeah.
Let's just do the top marginal tax rate. I'll do it for you right now, because
Yeah.
it's going to be over $300,000 if she has no other income. If she's got other income now, which most likely she is, it's going to be close to like $375,000. Yep.
Yeah. So again, be careful. It is RSP season right now, so you're going to see commercials everywhere. All those things. What I'm going to say to people is you have to just kind of do it carefully and see what you've got. And it all depends on your, here's the thing. If you're a government employee, I don't know why you would be doing RSPs. And that's just my own opinion. But like, if you have a pension, a bulletproof pension from the federal government that's indexed with inflation, and your pension adjustment is going to be roughly 15 grand a year, probably.
Yep.
The pension adjustment, if you have a pension, will reduce your contribution room by that same amount.
So you're going to be getting between $55,000 and $60,000 a year. Plus, you're going to be getting CPP.
Yep.
And then you don't really want any more income that way. If you did something else like TFSA, that's great, because that's, pulling that out is tax free.
Yeah, well, it's about cash flow and where the cash is coming from. That's kind of where you really want to look at with these types of things. So they're a great way to reduce your taxable income in any given year. But it should not be your only retirement vehicle. It shouldn't be your only basket.
And it takes planning. So please don't just run in on March 1st, like screaming. I mean, I had a client last year. I gotta be honest with you. I had a client here last year, March 1st, at 10 o'clock at night. And luckily I happened to know their agent was actually up and got it done. But then there wasn't as much planning done on that, right? But you just got to be really careful. Like, RRSPs and proper planning is like, there's more than just RRSPs in every equation. Our retirement, you'll agree with this, Lyle, is an algebraic equation.
Sure is.
There's tax involved. There's tax in the future involved. Unfortunately, we have to talk about, hey, what's your mortality going to look like? In my family, mom passed away at 50. Dad has high blood pressure and heart issues, and I'm a bigger dude. So my mortality is, I'm probably gonna be dead before 75. Just being purely honest.
Matt.
So I take that kind of stuff into consideration. I really do.
I mean, you kind of have to look at it. And here's the thing: you're gonna really have egg on your face if you live till 85. But
I'll be feeling great.
and here's the other, like, if you do an RRSP, like, it is RRSP season, you have the first 60 days in the year to get a contribution for, and here's what we do is employers have to have their T4s out by basically now. So Matt, you're dealing with all the T4s for all your clients. Those T4s have to be out now with the bookkeepers and everything else and all that stuff. So you're going to get your T4 in the next probably a week or two, and you're going to see it. And then you're going to take a look at your taxes that you paid and the amount of money you made and the Canada Pension Plan withdrawals and everything like that. If you have any questions, give Matt or I a call.
Yep.
Now, what most people do is they take a look at it, they plug the numbers into the computer software on the internet, and it says you're going to have to pay $12,000 in income tax, and you've paid only 10. Oh, dang, I'm going to owe $2,000. I better get an RRSP. So you go out, you get a $5,000 RRSP, put that in there. That eliminates that owing taxes. That is 90% of what I see in my business for RRSP season. So now being said, being COVID and everything, and I used to drive around and collect up $1,000 RRSP checks when I first started in this business. We have the ability to do it online now. And even through my business, I can do it online for my clients as well. So you don't even have to leave your house to get an RRSP. You can literally phone me. I'll send you a link and you can get an RRSP and put it into the market. And then also we can plan around that and see what is the best solution for you. If it is an RRSP, we'll do it for now, and then we'll take a look at later on, because there's nothing you can't undo with given enough time. And again, be careful of your pensions and pension adjustments. That is a double-edged sword. And I know a lot of pensioners that have a ton of RRIF money and they don't want to take it out. And then on death, so Matt, if you die at 75, your wife gets whatever's left over. And let's just say when your wife passes away,
yep.
Then it's taxable.
Yep, you got it.
And the same thing in my situation too. So it's a spousal rollover, it's tax-free. And then at the end passing of the last spouse, it's 100% taxable. So the kids don't get the RRSP. The kids get whatever's left over, and then they get the cash. But the government is first payer on all of these situations. Anything to add on that, Matt?
No, the government wants their money. Make sure they get paid.
And here's the thing: is you are a money making machine, so go out and make money. Like, there's nothing wrong with making money, and putting it away properly is what we really want to talk about. And then Matt and I do specialize in business owners, so we do have to do our shameless plug of business owner help out. If you are a business owner and you're thinking about doing an RRSP, can you please call or email Matt or myself before you do it? Because it might not be your best option. It might be your only option, but it probably won't be. And I know it won't be your only option, but it won't be your best option probably.
No.
More often than not, business owners and RRSPs don't really get along, unless in certain circumstances where they made a bunch of money one year and they need to drive their income down for that year.
Well, we use it a lot more these days for if you're trying to qualify for a mortgage.
Yeah, that's the big one, is the mortgage rules and trying to qualify for mortgage. And we're gonna have a session on mortgages and mortgages and lending.
That would be a good one, because I still like the menu one.
Yeah,
product, because
we're gonna do a whole session on that.
I hate having to qualify for mortgages. It's painful for business owners.
If you've qualified for a mortgage in the last couple of years, you're going to see that it's been really difficult.
Business owners, they hate business owners.
Yeah, they do. They really do. CPP, we did a session on Canada Pension already. You're going to have to be careful if you're a business owner as to what you're doing. Old age security, that's free money from the government. That's money that you've contributed your tax dollars for your entire life. And that's a recognition of the tax dollars that you've paid. It's also sometimes just a bare minimum of what people have to earn at 65 because they can't work anymore. There's real estate income, equity takeout on your real estate that you have. You can do corporate earnings, salary, or dividends. Now we can talk about that till we're blue in the face. IPPs, expensive. And again, RSP RRIFs, 100% taxable at retirement. The tax-free savings account, I think, is one of the best vehicles that are out there. But the problem is you got to take money out of your corporation to pay into a TFSA. So that is the problem that I see with that. Anything to add on that, Matt?
When it comes to business owners, this really does take your accountant and your financial planner talking together on most plans, especially if you're earning a lot of money.
Yeah.
It's not a 5-minute calculation. It takes time, and proper planning really takes into consider. I mean, the reason I was so busy is a lot of my big clients, the second COVID came along, I got phoned for 3 reasons. Probably you're the same, law. One, how do I pivot my business, making sure that I'm still going to be profitability?
Yeah.
Can I take advantage of all the government money out there? So because I'm going to have to pay the tax anyways. And the third one was, okay, well, let's look at my investments. A lot of people started looking at that, and it's a good thing. A lot of people are like, okay, so let's look at my overall investment strategy with taxation. And that was for you. We've been preaching this, and people are finally. This year, especially in the summer, I did a lot of that. I did a lot of helping business owners look at okay, what vehicles are you using? Is there another vehicle that we can use? And I don't think we're done yet. A lot of people kind of said, okay, Matt, let's put that on hold and see what life looks like after January. I mean, that's what I'm hearing, Lyle. It's like a lot of people are like, okay, let's start taking advantage of some of these other strategies, but I got to wait a little bit just to see what the market shakes out to be like.
And we could talk about the market till we're blue in the face, but this is the thing, is that's why we do these we used to do lunch and learns, these tax talks, because I found in my business that I'm not just going to go out and sell an RSP or insurance policy or any of those things. You have to look at the tax implications of what you're doing every single time. And if you don't, you're going to be paying tax. So there's like, it's like compounding interest, the saying about compounding interest. Those who understand compounding interest get it. And those who don't understand compounding interest pay it, right?
Yeah.
This is exactly the same thing. If you don't understand taxes, you will pay more tax. If you understand tax, you will pay less tax. It's a simple solution. And that's what we're trying to do with these sessions, is to just get people financially literate and to see what tax erosion can do to their portfolio, what it can do to their life, what it can do to their family situation, everything. Taxes are first all the time. And we have to be very careful of that. So that being said, I think we are out of time, Matt. What's anything to add before we cut everybody loose?
Yeah, just if you're thinking about RRSPs, just make sure you call your financial planner before March 1st.
Yeah.
I mean, honestly, Lyle, you'll probably agree with this. The best way to do RRSPs is just to be monthly.
Yeah, dollar cost average. You can just do it $100 off, $100 a month, $200 a month off your paycheck.
Yeah, but then you're not scrambling at the end of the year either. I mean,
And you're not trying to get a loan, RSP loans. There's companies that just do make a business on RSP loans, right?
Oh, I know. And they make a lot of money.
And then RSP loans are, you got to pay that back over the next 3 years. So
yeah, but then you're going to need another one the next year, and another one next year.
They just kind of ladder up, right? So again, it's a treadmill.
Like a payday loan to me.
It's the treadmill effect, man. You're on the treadmill and you just got to keep running, and you never get to slow down. You just have to run faster. And that's the problem, right? So Matt and I are trying to eliminate that, that treadmill for everybody. So that being said, have a good February, everybody. Try and stay warm out there. It's a little bit chilly. And
just like last time, be patient with everybody. It's sometimes out there, don't fall in with this negativeness, and just realize that everybody's struggling at the same time. Just be kind.
Yeah, be kind.
People, be kind.
Be kind, and just kind of put your head down. Again, I've had clients come in. I've had new clients come in from all of this, and through these sessions, I've had people reach out and appreciate some of the things we've said. We've had people challenge us on some of the things we've said, which is great. I don't mind being challenged on things, but we're not going to be shut up, and we're not going to be put out there. We have something to say, and all we're trying to do is educate everybody.
Yep.
As far as what is going on out there, because if you, like I said, if you don't understand tax, you're doomed to pay more. And the only one who benefits on that is the government.
Yeah. Be kind. Don't be a Karen.
There you go. All right, everybody. Have a good one.
Talk to you later.